There is a version of you that exists only in economic theory. This version earns money, evaluates every option rationally, and always chooses whatever maximizes long-term wealth without hesitation or emotional interference. This version never panics during a market dip, never holds a losing stock too long, and never spends a tax refund on something it would never have bought with regular income. That version does not exist. It has never existed. And the financial advice industry has spent decades designing products, strategies, and guidance for someone who is not a real human being. Take Nadia, mid-level operations manager, earns the equivalent of $72,000 a year, competent, organized, reads the financial headlines. Last year, she held on to a single stock for 11 months after it began declining, because selling felt like admitting the loss was real. Meanwhile, she sold a different holding 2 weeks after it peaked, locking in a small gain she was afraid to lose. Her portfolio underperformed a basic index fund by more than 8% that year. Nadia is not financially illiterate. She is running the same cognitive software every human being runs, software that was not written for financial markets. What governs financial behavior in the real world is a field called behavioral finance. It emerged from the collision of cognitive psychology and economics in the latter half of the 20th century. What it found was deeply inconvenient for the rational actor models that classical economics had built its entire framework around. The research showed that human beings do not make financial decisions by calculating expected value and selecting optimally. They make financial decisions using cognitive shortcuts, emotional signals, and mental frameworks inherited from an evolutionary past that was not designed for mortgages, compound interest, or investment portfolios. If you have ever looked at a financial decision you made and genuinely could not explain why you made it, this is the explanation. Not a failure of intelligence, not a failure of discipline. A set of documented, predictable, universal cognitive patterns that operate below the level of conscious reasoning in every human being without exception. Understanding what those patterns are is not just academically interesting. It is the most practical financial education most people will ever receive. Because once the patterns are visible, they can be designed around. And designing around them is worth more than any investment strategy, budgeting system, or financial influencer's 5-step framework. Here are 5 of the most consequential behavioral patterns the research has documented, and exactly how each one is costing households real money right now. The first is loss aversion. The foundational research in behavioral finance was conducted by psychologists Daniel Kahneman and Amos Tversky. Their work on prospect theory, which contributed to Kahneman's Nobel Prize in economics in 2002, established something that has since been replicated across dozens of studies globally. The psychological pain of losing a given amount of money is approximately twice as powerful as the pleasure of gaining the equivalent amount. Losing $100 does not feel like the mirror image of gaining $100. It feels roughly twice as bad. This asymmetry sounds like a minor quirk. Its financial consequences are not minor. Loss aversion explains precisely what happened to Nadia. It is the mechanism behind what behavioral finance researchers Sheffrin and Statman labeled the disposition effect, the documented tendency of investors to sell winning positions and hold losing ones. Terence Odean of the Haas School of Business at UC Berkeley analyzed the trading records of 10,000 individual brokerage accounts and found that investors realized their gains at a rate 50% higher than they realized their losses. The stocks they sold for gains subsequently outperformed the stocks they held at a loss by an average of 3.4% over the following year. The emotional logic of avoiding the pain of a confirmed loss was costing investors real and measurable returns. Loss aversion also explains why people avoid investing during market downturns, precisely the moments when asset prices are lowest and the mathematical case for buying is strongest. As documented in research published by the Financial Planning Association in February 2026, loss aversion causes time-inconsistent financial behavior in which individuals avoid investing due to fear of short-term volatility, sacrificing substantially larger future gains in the process. The instinct designed to protect from harm ends up producing it. The second pattern is present bias. Research across behavioral economics has consistently found that human beings systematically overvalue things available right now relative to the same things available in the future. The preference is not just for the present. It is a disproportionate, mathematically irrational preference that cannot be explained by any reasonable discount rate applied to future outcomes. Researchers Brown and Previtero, in a study drawing on 3 separate administrative datasets published through the National Bureau of Economic Research, found that individuals with present biased preferences were measurably less likely to participate in supplemental savings plans, took significantly longer to enroll in retirement accounts when they did participate, contributed less once enrolled, and were more likely to stick with default portfolio allocations without reviewing whether those allocations were appropriate. Every dimension of retirement savings behavior was impaired by the same underlying mechanism. The practical translation is direct. The version of a decision that involves spending money now wins against the version that involves deferring it into savings almost every time, not because spending is rationally superior, but because the present feels more real than the future. A paycheck is concrete. Retirement is abstract. The brain allocates attention accordingly, and savings consistently lose that competition unless the decision is removed from the equation entirely through automation. Present bias is also the mechanism behind a pattern researchers call time inconsistency. Ask most people whether they plan to save more next month than this month, and the majority say yes. Track those same people to next month, and the proportion who actually increase savings is small. The future self who was going to behave better is perpetually displaced by a present self who finds the immediate cost of saving more vivid than the distant benefit. This cycle repeats indefinitely unless something structural interrupts it. If this reframe is landing, the subscribe button is how this kind of financial education keeps reaching the people who need it most. The third pattern is mental accounting. Nobel laureate Richard Thaler, whose foundational work in behavioral economics contributed to his Nobel Prize in Economics in 2017, demonstrated that people do not treat money as a single interchangeable resource. In a landmark paper titled Mental Accounting Matters, published in the Journal of Behavioral Decision-Making, Thaler documented how individuals segregate money into separate mental categories based on its source and intended purpose, then apply different rules to different categories even when the underlying value is identical. A tax refund is economically identical to earning the same amount through regular income. It is the taxpayer's own money overpaid to the government and returned. Research documented by the Federal Reserve Bank of St. Louis confirms that people treat tax refunds as windfall money and spend them significantly more freely than equivalent regular income. The mental category of bonus overrides the mathematical reality of the balance sheet. This same mechanism explains one of the most persistent and expensive financial behaviors documented across consumer finance research. Households that simultaneously maintain low-interest savings accounts while carrying high-interest credit card balances. From a purely mathematical standpoint, this is indefensible. Eliminating the credit card debt with savings would produce an immediate guaranteed return equal to the interest rate being paid, typically well above what the savings account earns. But the savings account occupies a mental category labeled security, and the psychological act of touching it to pay off debt feels like a loss, even when the net financial position would improve immediately. The emotion of the mental category defeats the arithmetic of the balance sheet consistently and predictably. The fourth pattern is anchoring. When people encounter a number before making a financial decision, that number influences their judgment even when it has no logical connection to the decision being made. This is anchoring, and it is one of the most extensively replicated findings in behavioral economics, documented by Kahneman and Tversky and confirmed across subsequent research in real financial contexts. Salary negotiations anchored by an employer's first offer produce systematically lower final salaries than negotiations where the employee names the first number. Prices marked down from artificially high original prices feel like bargains, even when the final price exceeds market value. But anchoring's most damaging financial application is in investing. The original purchase price of an asset has no rational bearing on whether it is worth holding today. The only relevant question is whether expected future returns justify the current price. Yet, because the purchase price is the strongest available anchor, it dominates the evaluation. People wait for losing stocks to recover to their purchase price before selling, for houses to reclaim their original value before listing, for any asset to reach the anchor before releasing it, regardless of whether that anchor has any connection to present or future value. The anchor has no information content. It still governs the decision. The fifth pattern is overconfidence. A consistent finding across behavioral finance research is that investors systematically overestimate their financial knowledge and their ability to make superior investment decisions. Research by Brad Barber and Terence Odean, published in academic finance literature and drawing on brokerage account data covering tens of thousands of investors, found that the most actively trading individual investors significantly underperformed the least active investors after accounting for transaction costs. The overconfident investors believed they had identified opportunities others had missed. The data showed they were primarily generating transaction costs while underperforming index benchmarks. Overconfidence also produces underdiversification, as investors who believe in their ability to identify winning assets concentrate their portfolios instead of spreading risk, a behavior that increases volatility without improving expected returns. And it produces reluctance to seek external financial guidance because acknowledging a need for advice requires acknowledging a gap in one's own competence, which overconfidence makes psychologically uncomfortable. What all 5 patterns share is that they are not failures of character. They are features of standard human cognitive architecture, shaped by an evolutionary history that did not include financial markets, compound interest, or 30-year retirement horizons. The brain is not broken. It is running software that was not written for the environment modern financial decisions require. This distinction matters because it changes the nature of the solution. Telling someone to exercise more willpower, be more disciplined, or simply try harder is asking them to fight their own cognitive architecture without adequate equipment. The behavioral finance research that has accumulated over the past 4 decades consistently shows that the interventions which actually work do not fight the architecture. They design around it. Automation removes the present bias problem by eliminating the savings decision entirely. Commitment devices reduce the loss aversion problem by locking in future-oriented behavior before the present self can override it. Financial systems that make the better choice, the default, remove the mental accounting problem by ensuring the right behavior happens without requiring ongoing conscious effort. Awareness of anchoring makes it possible to consciously question whether an initial number is distorting a current evaluation. For anyone who found this useful, passing it on is one of the simplest ways to give someone a head start most people never receive. Content like this exists because people choose to support it. A like or a subscription is what keeps these ideas reaching the people who need them most. One action this week. Identify the most recent financial decision you made that surprised you in hindsight. Write down the number that was in your head when you made it. Then ask whether that number was relevant or just an anchor. That single question, applied once, begins to make the invisible visible. Here is where this ends. There is a version of every person that exists only in economic theory, rational, unbiased, always optimizing. That version does not exist. What exists instead is a human being running predictable cognitive patterns that behavioral finance has now spent decades documenting. Understanding those patterns does not make someone immune to them, but it makes the patterns visible, and visible patterns can be planned around. Invisible ones cannot.